I've met hundreds of millionaires, and the number one thing that they all have in common is majority of their wealth is invested in the stock market. So why shouldn't you? What's up, guys? Welcome to the channel. This is your boy, Kenny Finance, and you may have stumbled upon the most important video related to finance that you will ever watch. Because today I'm giving you guys $1 million worth of game completely for free, because we're diving into the fundamentals of how to invest and how to kick off your investor journey. Now, look, if you are completely a novice in this space and never touched a single stock in your life, don't have any accounts, this is the exact video for you. But if you've been in the game for a while, you have a few accounts, a couple $100 invested in the stock market, this is also for you too, because later in the video, I'm gonna show you guys some of my favorite tips to level up your investing. Now, lastly, if you're a pro and you work on Wall Street as a hedge fund investor or private equity investor, and you know everything about finance, this video is still for you, because it never hurts to revisit some of those fundamentals and understand why we got into the game in the first place. Now, before we jump into the mechanics of how to invest, we need to first clarify a few things about the setup and whether or not we should be investing in the first place. Now, I recommend that there are 3 situations that you take care of before you even think about getting started investing. Now, the first thing is if you have any high interest debt, whether that be personal loans, credit card debt, payday loans, or anything that you owe that has a significantly high interest rate, don't even think about investing right now. I highly encourage you to, whatever money you do have, pay off that debt as fast as possible, because it doesn't matter how good you are investing in the stock market, because if you have that debt growing and interest compounding on itself, it's gonna bite you in the butt and ruin all of your returns. That's not fun at all. Now, number 2 is having an emergency savings fund. I recommend for everyone and their mom and their grandma and their dog to have at least 3 to 6 months of living expenses saved up for the worst case scenario if anything happens. You could lose a job, you could fall ill, anything could happen to where you just need to have 3 to 6 months of cash saved up to cover your rent, your mortgage, food, anything that's essential. Have that in cash and accessible. So have that first before you even think about investing. Now, the third and final thing that I like to think about as prerequisites before you even get started investing is a mindset thing. I can't tell you how many people ask me, hey, how do I take $100 and turn it into $1,000 by this weekend? I'm like, look, you're better off going to go find a way how to make $900 extra versus trying to flip your way to $1,000. Because this right here is not a get rich quick scheme. If you're here for day trading or if you're here for profiteering advice, this is not the video for you, unfortunately. I'm here to show you guys how to build the tools and the habits and the systems to build sustained long-term wealth. That's the name of the game here. This channel right here, and by the way, if you're not a subscriber, you should totally hit that subscribe button. But this channel is designed to give you guys everything you need to make long-term investing decisions, because that's where the real money and the real wealth is made. I work professionally as a private equity investor on Wall Street, and all I think about every day is long-term investing. When we're going to go buy a company, we're thinking in 3, 5, 7-year time horizons. I don't care about tomorrow. I care about 3, 5 years from now, because that's where the real wealth is made, and that's where this element of compound interest really starts to kick in. And I'll touch on that in a little bit. Now, let's dive right into the mechanics of how the heck to get your investing journey started today. Step 1, open an account. Now, if you're over 18, use your fingers, go on your computer, sign up for an account at any investment platform that you like. I'm gonna talk about the ones that I love, but if you're over 18, you can do it. Now, if you're under 18, get creative. So when I was 16, I actually opened my first investing account using my sister's name and social security number. What I would do is she would have the account, it's in her name, and every day after school, I would come and trade stocks. And then once I became 18, I sold all those stocks and then rebought it once I became 18. So there's no real excuses why you shouldn't get in the game. Get creative. But I don't condone underage investing or illegal activities, by the way. Now, you may ask yourself, what account should I open? There's like hundreds of finance investing apps. Now, I'm gonna break it down into a very simple element. Do you want to be an active investor or do you want to be a passive investor? Now, active investor is you are going to be making independent decisions of what to put your dollars into. Now, if you want to make a passive decision, you are kind of giving away that control to either a person, an advisor, or a robo-advisor to sort of make those investing decisions on a day-to-day basis for you. Now, both of those have their perks and their benefits. Now, if you're on the active approach, I think the number one platform that you could use for active investing and choosing what to put your money into is Robinhood. You can't beat it. There's no commissions. You simply can buy whatever stock or ETF you want, and you can buy that on their platform. Super simple, very easy to use. Now, if you're on the passive approach, there are a bunch of sort of robo-advisors, which are computer algorithms that kind of make decisions based on your risk tolerance. All is required from you is simply elaborate if you have high, medium, low risk tolerance, as well as any goals or time horizons that you may have with your investing objectives. And then they sort of curate a portfolio based on that to make sure that you hit your goals. Now, there's a bunch of robo-advisor platforms, Betterment, Wealthfront, etc. But I think my favorite is a platform called Acorns. Now, Acorns is actually pretty sick. So what it is of course, it's an investing platform, but it actually attaches to your credit card, your debit card, so that whenever you go to a store and purchase anything, it rounds up that purchase to the next whole dollar and reinvest that portion of that spare change into the stock market. Now, let's say, for example, you went to Starbucks and you bought yourself a caramel macchiato for $3.50. I don't even know if they're still that cheap. Now, what you'll see on your credit card or debit card statement is actually $4 because that 50 cents is then invested into an Acorns account that invests into the stock market for you. So you're kind of paying yourself every time you actually spend money. I think it's genius. Now, I've used that thing for 10 plus years and I barely look at the account, but I checked it the other day and have tens of thousands of dollars of spare change that has been invested in the stock market. I call that free money. Now, let's move on to what exactly to put your money into if you were on a platform like Robinhood and you wanted to make your own decisions. Now, if you wanted to buy your own stock, I recommend you think about your favorite companies that are out there. Do a little bit of research, understand what that company does, what's their product or service, who their customers are, how their revenue is generated, how it's been trending or performing, how are they doing compared to their competitors, how's their profitability, all that stuff. If you spend 10 to 20 minutes on a company and think you know what they do and you want to buy their stock, I don't recommend you do that. Spend a few days to a week just kind of digesting yourself into everything about that company so that you can make an informed decision. Now, this channel, it's actually illegal for me to give investment advice. I will never tell you what stock to buy, okay? FYI. Now, if you want to take a different approach and not invest in one single company, but instead you wanted to invest in a diversified approach, there's a thing called ETFs that you can invest in. Now, Kenny's teaching moments. An ETF is what we like to call an exchange traded fund. And you can think of that as a basket of stocks. Now, when you invest your money into an ETF, that ETF or fund is then invested in a bunch of different companies. So instead of having exposure to just one business, you have exposure to a bunch of different businesses. So if I were to buy SPY, which is the S&P 500 index, instead of me buying one company in the S&P 500, that SPY index fund or ETF gives me exposure to all 500 companies in the S&P 500. That's pretty diversified. Now, investing in ETF tackles one of the most important objectives when it comes to investing. And it's probably one of the most important fundamental rules, and that's diversification, of spreading out your investments and not putting all your eggs into one basket. Because if one of your companies falls 20%, if that was the only stock that you owned in your Robinhood, you'd be pretty salty. But if it was in an ETF, one of those companies going down 20% is not gonna make or break the bank. So diversify. And the best way to do that is an ETF. Now, step 3, how much to invest? If it was up to me, I would invest 100% of my income into the stock market, but that's not realistic. We got bills to pay. But it's recommended, and the experts say that you should invest 10 to 20% of your income into the stock market. Now, you're watching this channel, you're a subscriber, you should probably do the 20%. Now, it's important to understand that don't think of how much dollars you have to invest related to what stocks you can buy. If a stock is super expensive, like Berkshire Hathaway, which is $600,000+ a share, don't be scared, right? But instead, think about it as you can find a way to invest in the stock market with any amount of dollars, believe me. Whether you have $5 to invest or $5 million to invest, you can still get some skin in the game. And there's actually a new feature that most of the investing apps have started to roll out, and it's this element called fractional ownership, to where if you have a certain amount of dollars, you can still buy that specific stock or ETF. It's just that you'll have fractional ownership if you don't have the whole price of what it's trading at. Now, say for example, a stock trades at $100 a share and you only have $50, you will have a half of a share. Now, it'll still go up or down percentage-wise based on where that stock trades, but it'll just impact that half a share that you have. So it's pretty cool. Now, let's recap where we've gone so far. Number one, open an account. If I were up to me, I would do Robinhood, Betterment, Acorns. Simple enough. Now, picking what to invest. You may not have time to invest and research all these different companies. Just buy an ETF and it's diversified. Vanguard has a bunch of really good ETFs. Check those out. Lastly, how much to invest? There really isn't any minimum. Whatever you have, and if it's 10 to 20% of your income, put it in the stock market. That's how you get started. Now, here comes my favorite pro tips about to step up your investing game. My first pro tip is to automate. Now, I tell all of my friends that they should be spending their hard-earned money and their hard-earned time traveling the world, eating good, and spending time with their friends and family. They should not be spending time manually paying their bills or their mortgage or their rent or manually trying to allocate their dollars into a savings account. Everything should be automated. In this day and age, press one button to put a lot of stuff into motion. Now, take that same principle and apply that to your investing. All the investing apps now have a either auto deposit or an auto purchase option to buy stocks. Right? To where if you want to automatically every 2 weeks buy a share of this ETF, it'll automatically do that for you. So why not automate it? That way, it builds the habit of staying in the game, building routine, automatically investing, and it kind of builds in the background while you live your everyday life. Now, my second favorite tip when it comes to investing like a pro is to stay informed. And what you're going to want to do is consume as much content as possible as relates to companies, industries, the economy, everything that could possibly impact whether or not a stock goes up or down. You want to be informed and stay ahead of the curve. And now, if you're anyone like me that works a crazy demanding job, that has family and friends that want to spend time with you all the time, that have dogs that want pets every 3 to 5 minutes, sometimes you just don't have the time to watch CNBC or Bloomberg all day, every day. Or quite frankly, you may not be interested in reading 10, 20-page articles on Wall Street Journal, New York Times, or The Economist. Sometimes you want what's important, what's relevant in your inbox, and a newsletter. That's what I do. Every Friday, I read this newsletter called Tomorrow's Fortune. You can check out the link below. It's super fun, 3 to 5 minutes, entertaining also, and it summarizes all the most important pieces of information and trends that are happening in the economy, in the stock market, in artificial intelligence, in crypto, in real estate, side hustles, you name it. It gives me everything I need to stay ahead of the curve and invest it today to unlock tomorrow's fortune. It sounds kind of catchy, but it's actually pretty cool. So check out that link below. It's completely free to subscribe to that newsletter. Every time it hits my inbox, that's the first thing I read on Fridays so that I'm on top of all the news that's most relevant to me, and I love it. Now, my third and final tip when it comes to investing is to never sell. Now, I understand that one may be a little bit controversial, but trust me, investing is a long-term game. One of the absolute legends, Charlie Munger, who was the number 2 at Berkshire Hathaway, which is Warren Buffett's holding company, said the big money is not in the buying and selling, but in the waiting. Now, that's hyper important because you're not going to make significant returns buying a stock today and selling it tomorrow. You're going to make a lot of money by buying a good stock today, buying more of that stock whenever you can, and then watching that thing grow for years. That's where the big money is made. So never sell. Now, the reason why everyone tells you to wait is because Albert Einstein said that the most powerful force in the entire universe is compound interest. Now, let me show you why. Say, for example, you have $100 invested in the stock market. If you take that $100, invest it in something that gets you 10% return, at the end of the year, you have $110. Now, if you keep it in the stock market, you're investing not just $100, but instead you have $110 invested. And say you get another 10% return. That then becomes $121 over 2 years. Now imagine that incremental impact every single year for decades. That's big money on the way. Now I'll show you a diagram that shows if you have that $100 with a 10% return over a 30-year period, this is what you could have at the end of 30 years. That's hyper important. And investing for compound interest is essentially a snowball effect because as it rolls down that hill, it just accumulates more and more and more, and less work and less effort you have to do. Just have those dollars working in the background for you and watch the magic work itself. Now, if Charlie Munger and Warren Buffett can trust compound interest and keep their money in the stock market, you can sit your butt down for a few years and have some skin in the game. and let it work itself out. So this tackles everything that I wanted to cover in today's vibe session as we unpack everything as it relates to the fundamentals of investing in the stock market, building a portfolio, finding out what kind of accounts to open, finding out how much to put into the markets, but more importantly, putting something in regularly, starting early, and letting compound interest work for you. Those are the most important pieces. This was super fun, unpacking some of the fundamentals of how to get invested in the markets today. Now look, it is not easy at all, but trust me, I started in this game 10 plus years ago, and I'm just now starting to see some really awesome fruits of the labors of my sacrifices and my early investment decisions back when I first started investing. So get started, trust the process. It's so worth it. And investing is actually only one piece of the overall equation towards building significant financial wealth. If you actually want to up your investing game and take that to the next level, you kind of got to think about upping your income earning game and take your income earning potential to the next level as well. And lucky for you, in this next video, I unpack some of my favorite passive income ideas that help me personally make tens of thousands of dollars that I just put right back into my investment accounts. So that snowball effect, it's really snowball. That's it, guys. If you enjoyed this video, hit that like button. I appreciate you rocking with us. Leave us a comment. I would love to hear from you. And most importantly, get invested early, and stay in the game. I'll catch you in the next one, guys. Peace.